Bloomberg Audio Studios. Podcasts, radio, news.
Private credit, where heavy hitters from Blackstone to Sixth Street have recently warned that returns will narrow following years of explosive growth, and that growth has been explosive. We spoke with Akila Graywall of Apollo on her outlook.
Credit has grown tremendously, and our view is that it's going to continue to grow. Our view is that private credit is an enduring asset category, and we've expanded the definition of what that means. We focus not just on kind of direct lending. Of course, we have a big franchise that does that, but I think our leg up has really been the fact that we have an insurance balance sheet that has allowed us to originate private assets and private credit across the risk-return spectrum.
Joining us now is a man that knows this space very well, a veteran and a titan, Ken Kencel, president and CEO of Churchill Asset Management, a $57 billion private capital affiliate of Nuveen. Ken, thank you so much for joining us this morning. This weird thing is going on at the moment. Private credit is so hot. You look at your equity brethren, and there's this talk of zombie firms popping up more than ever. But private credit is so popular. You have hedge funds like Point72 and Millennium launching strategies. What do those dynamics say to you that tourists are now coming in?
A lot of tourists, a lot of new entrants. Look, I think there's room for all of the players. I look, at the end of the day, private credit, in our view, is all about differentiated sourcing, origination, and ultimately relationships, right? So I think you will have new entrants. I think there are certainly places to go with that capital. Whether those are the most optimal places to go with the capital and where they're lending, I think is going to be an interesting question. But you've got established players that have relationships built over decades, and I think those firms are going to continue to enjoy the benefits of those relationships. But the new entrants that come in, I think, will probably focus more on opportunistic strategies, areas where they can drive somewhat higher returns. Particularly if you look at hedge funds, right? That's their thing, right? They're looking for, a niche or a way to drive incremental return. So I think those firms will focus more on opportunistic areas, and relationship lenders, folks like ourselves that rely on those historic differentiated sourcing and relationships, I think have a place.
Ken, just one point on that. We've seen this movie play out before. We had some of the Tiger Cubs get into private equity, for example.
Yes.
It didn't work out well.
Yes.
A lot of them took a lot of losses and were forced sellers into the market. Who's to say that won't happen again if you have firms, again, whose history and credentials aren't necessarily in private credit?
Yeah, well, I think, look, part of where I think you'll see them go is in distressed areas, where they can come in and provide capital and maybe a higher risk scenario. Look, the world we focus on is more traditional, right? We're looking for high quality, mid-market businesses that are market leaders in their space, non-cyclical, where we can drive a very consistent long-term return. So you've got kind of the regular way private credit, and then you've got situational or opportunistic credit. I mean, the reality in private credit is you hear about it as a monolith, right? We're in private credit. It's venture lending, it's distressed lending, it's upper middle market, lower middle market. So there are lots of flavors of private credit. It's, asset-based lending. We saw with, First Brands and Tricolor. So it's much more differentiated. And I think there are niches where those hedge funds will play, but it's not where we play.
You play in the middle market. The firms that you invest in here in the U.S. are $10 to $100 million in EBITDA, right?
Yes.
And I'm wondering, there's two trends, big headline trends from the Trump administration. One is the tariffs, and I imagine that is much more difficult for middle market companies to deal with than mega cap companies. The other is deregulation, which must be a tailwind for middle market companies. So how do those two balance out? Yeah,
sure. Well, the interesting about tariffs is that when you look at our businesses, the companies we finance, exclusively U.S. companies, primarily service businesses, that interestingly have very little influence on their business internationally, right? So very, very limited, international customer base for these businesses, U.S. mid-market service companies, and actually very minimal manufacturing. So when you look at our concentration or tariff issue in our portfolio, less than 10% are really impacted at all by tariffs. So the tariff dynamic has actually turned out to be a pretty good thing for us. And in fact, our investors see that and like the fact that there's limited tariff exposure.
What about deregulation? Do your companies have to spend less to deal with that kind of compliance?
It's certainly a positive. Look, I think deregulation overall is a good thing, and certainly mid-market companies, those that maybe don't have, or want to invest heavily in dealing with regulation, I think, benefit from not having to do that. So I think deregulation is a net positive overall. The tariff dynamic, I'd also say, for us, is something that has turned out to be even a positive from a fundraising perspective, right? I think when tariffs came in, there were a lot of questions about, oh my gosh, what's this really going to do to portfolios? And as things have played out over the last several months, investors can see that it really hasn't had a significant impact on our portfolio. So that's spurred more fundraising, which is great. But I'd also say that when you think about our dynamics going forward, being away from tariffs versus the broadly syndicated market where you have larger companies that have much more international exposure makes us more attractive on a relative basis as well.
Ken, one of the things that makes you unique is that you're staying in middle markets, because it feels like every private credit company wants to get into big infrastructure AI, that they're all touting how great it is to be with these blue chip IG companies.
Yes.
Is this also you maybe seeing risk in there? Participating in that market?
Yeah, no, it's a great question. And actually, I spoke with Romaine about this at a conference a few months ago. There was a panel talking about exactly that, the reindustrialization or the industrialization due to the data centers and how that's playing out. We did some research when I met with him in advance, because I always know what a great job he does in all of his research.
He does.
And what we found is that we have about $6 billion invested in our portfolio, not in the data centers themselves, but in companies that are mid-market companies that are supporting data centers. So I think that there's a misconception that it's just building these data centers that's driving the activity. The reality is there are thousands of companies in the mid-market that are participating in that. We finance, for example, HVAC build-out businesses, right? Well, they're supporting data centers. Food service businesses that are actually supporting the workers that are working in the data centers. So I think it's a broad-based benefit to the economy. And I think while data centers are part of it, and obviously those are the largest dollars, we're not financing data centers, but we are financing the companies that are participating in that opportunity.
You mentioned fundraising is fantastic. What do you expect in terms of growth? I know you have tens of billions of dollars under management. You have 200 employees. What kind of growth do you expect?
Well, we just finished our annual investor meeting this week. I think we had something like $15 trillion of investors participating in the meeting. So I got lots of feedback on what we anticipate. And look, I think certainly our investors are looking for a more conservative profile. There's always the risk of recessionary dynamics from tariffs. And we haven't seen that at this point in our portfolio, but I think they're looking for us to stick to our knitting. I think, 5-6 years ago, investors, I don't think, fully appreciated all these differentials within private credit. Today, they like the middle market and they want us to stay there, right? So they don't want to see us, venturing off into some of these other areas, and we have absolutely no intention of doing that. But I think sticking to our knitting is important right now.
There's been a real big conversation that the reason you've seen a lot of the giants of this space go into other areas is because there's been real fee compression, and that in order to succeed, you need to asset gather when fees aren't as robust as they once were.
Yes.
Is that a troubling trend if we are moving into the commoditization of private capital?
Yeah. I think where you're seeing more of that is in the BSL market, right? In the large cap companies that now have a syndicated option and a broadly private credit option, right? So the private credit lenders that are moving into that space are actually competing with the syndicated loan market. So you've seen compression in spreads in the large cap market. Today, core middle market, what we do in traditional private credit, has about a 2 to 250 basis point advantage over the syndicated market. And I think a big reason for that is that compression of spreads we're seeing in the BSL world. So we like our space better, I would say, overall. But you're right. The largest private credit managers that are going into that space are competing with the syndicated loan market. Therefore, there's a lot more competitive dynamics that they're running into versus the core direct lending market, where, frankly, delivering $300, $400, $500 million solutions, there are a fairly limited number of firms that can do that. So we like our space a lot, but you're right. As you get into the larger deals, it's a much more competitive dynamic.
Ken, we appreciate you joining us on Open Interest, even on a day when Romaine is here. Romaine Bostic and Kate Michael.
Actually saw him earlier, so
they'll be anchoring the close at 3 p.m. A show you don't want to miss. Ken Kencel there of Churchill Asset Management.